Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the video is how to avoid double taxation legally as a US business owner in 2025. So talking about the double taxation, first of all we will discuss that what is it and why should our business care about it. Double taxation may not be the first thing you think of when starting a new business. However, it's an essential aspect for the corporation owners to consider as it affects their company and their shareholders. So, double taxation isn't avoidable and it applies to other income sources. Here, what corporation owners should know about when it comes to the double taxation. So first of all, they should know about that what is the double taxation. Double taxation refers to the act of paying income taxes twice on the same income. It can occur in three scenarios explained below. The first scenario is income from the corporation taxed for the corporation and its members. Then the second scenario is international investments and the international trade. The third is loans such as a 401k loan. Most commonly, double taxation happens when a company earns a profit in the form of dividends. The company pays the taxes on its annual profit first, then after the company pays its dividends to shareholders, shareholders pays a second tax. So which business entities experience double taxation? C corporation or a C corps, also known as just corporation, are the only business entity that experience double taxation. Other business entities have different ways of paying taxes that doesn't involve a second form of payment. So what are the tax rates for the corporations and the individuals? As of the most current tax year, there is a corporate tax rate of the 21%. This first tax applies regardless of how much the corporation earns annually. Their earnings will be taxed for the individual shareholders in a corporation according to their federal income tax bracket. This tax bracket depends on whether you file as a head of household, married filing jointly, married filing separately, or you file as separate, single. So tax rates for the individuals and the tax odd will depend on the dividends received from your corporation. The exact amount that you will owe can significantly, for example, the minimum and the maximum tax rates, the taxable income bracket, and the tax odd depend on your filing status. So for the head of households, 10%, for the 10% tax is the amount is $0 to $14,100, 10% of their taxable income. So 12% tax includes $14,101 to $53,700 plus for 12% of the amount over $14,100. Then comes about 22% tax, then 24% tax, 24% tax, which is about ranges between $85,501 to $1,63,300, plus 24% of the amount over 85 $1,500. Then comes 32% of the tax, then 35%, and then comes the 37%. So for the married couples filing jointly, 10% tax is about the amount is $0 to $19,750, and then followingly 12%, 22%, 24%, then 32%, 35%, and at the last 37%, that ranges between 6,22,000 and $51 or more, 1,67,000 and $67,307.5 plus 37% of the amount over 6 $6,22,050. For the married couples filing separately, the following is the amount of their taxes. For the 10% is the following amount, for 12% is the given amount, 22% for 24% is the amount which is mentioned here, for 32% for 35 and 37%. For the single filers, 10% is about $0 to $9,875, which is 10% of the taxable income. Then comes 37%, that is about 3,11,026 or more. So it adds up to the $83,653.75 plus 37% of the amount over 3,11,025. So, double taxation can be tricky tax principle to navigate, and it's crucial to get the details correct. Talking about the how the double taxation can be avoided. So, we will discuss how are the C corporations taxed, tips on how to avoid double taxation and reduce taxes. So, here's the complete guidelines for these questions. So, we will discuss now how are C corporation taxed. Setting up your business as a C corporation, C corp has many benefits including greater ownership flexibility and more growth potential than an S corporation or a limited liability company LLC. But what does that mean for your taxes, and what tax benefits and the strategies are available to a C corp that are not available to an S corp or the LLC? So, talking about this terms, we will be discussing that the following is a guide to the most common questions current and the prospective business owners have about C corp taxation and the strategies for lowering a C corp's tax burden. So, how are the C corporations taxed? The IRS taxes C corp as a separate tax-paying entities that engage in business, earn revenues, realize profits and losses, and distribute profits and or dividends to corporate shareholders. In the other words, C corps are not taxed as individuals, they are taxed as the business structure that is legally separate from the people who own and operate the business. So, in addition to various rules for income tax deductions and the depreciations, C corps also pay several other types of the taxes such as property taxes, payroll and unemployment taxes, sales and use taxes, and the excise taxes. Though some of these costs are passed on to the consumers, one unique aspect of the C corporations is that they are subject to double taxation. This means that a C corp's profit are effectively taxed twice. So, what is a double taxation? For the C corps, double taxation refers to the taxation of corporate profit at two different times. First, the corporation itself is taxed on their corporate income at the federal corporate tax rate of the 21%. Second, when the corporate earning and any dividend or profits are passed on to shareholders, that same profit is taxed as the capital gains on the shareholders' personal tax returns at an individual tax rate of 10% to 37%, and hence the term double taxation. C corp cannot deduct earning distributed to the shareholders either though there is no shortage of the proposals to the change. This is unfortunate fact. So, how the taxes to pay on C corp dividend distribution? So, C corp shareholders must pay individual taxes on any distributions of the dividends or net profits. The tax rates they pay are calculated based on the individual's income tax bracket. To avoid double taxation, then the owner of a C corp, particularly a small one, may not want to receive dividends because they are a form of double tax form of a taxable compensation. So in any case, dividends from a C corp are reported on the form 1099 DIV, and these forms are due each year on the 31st March. So here we will be talking about that taxes to pay on C corp capital gains. While capital gains for the individuals are taxed at a lower rate, net profits and the capital gains at the corporate level are taxed at the same corporate rate, 21%. Nevertheless, companies must record any capital gains as either short term or long term gains on their Schedule D form 1040, even though they are taxed at the same rate. Companies can offset capital gains with capital losses, but these offsets should not be confused with expense deductions from the income which are recorded separately. So when are S corps tax due? When we talk about this question, the answer is that the tax deadlines for C corporation depend on if they follow a calendar or a fiscal year. So, the first point in this discussion is if a business follows a calendar year, C corp taxes are due the same time as other calendar year taxes are due, which is the 15th day of the fourth month after the close of the tax year, unless that day falls on a weekend or a holiday, in which case they are due on the nearest business day afterwards. So the second point of discussion is if a C corp business uses a fiscal year, its taxes are due on the 15th of the fourth month after the end of its fiscal year. For example, if a C corp's fiscal year ends on 1st March, its taxes are due 15th July unless that day falls on a weekend or a holiday. So if a C corp cannot meet its initial tax deadlines, it can file a 6-month extension using IRS form 7004. So in 2024, the extension deadlines for our calendar year businesses in 15th October. For fiscal year businesses, the deadline is the 15th of the month, 6 months after the initial fiscal deadline. So here we will discuss that how do C corp file taxes. C corp file federal income taxes using IRS form 1120, the US corporation income tax returns. These taxes are based on net earnings, which are calculated after allowable deductions are taken. Deductions may include the cost of sales, wages, travel, and the other types of the employee compensation, advertising cost, some types of the internet cost, and the other taxes and the depreciation cost. How can a C corporation reduce their taxes? C corporation can lower their taxes and avoid double taxation in a number of ways. Following are the some of the most common strategies to save on the taxes. The first way to save on taxes or avoid double taxation is withhold dividend. So withhold dividend distribution so that the company's income only gets taxed once at a federal level of 21%. However, some of the shareholders may not approve of this tactic if it means giving up a passive income, or a suspicion can arise at the IRS if a C corp never pays dividends. So the second point is pay salaries, not dividends. Pay shareholders who work for the corporation salaries instead of the dividends. This option works because salaries are taxed at individual tax rates but are the deductible from the C corp, whereas dividends are not deductible. So Reimburse, the third point in this discussion is reimburse shareholder expenses. If a C Corp directly reimburses business expenses incurred by shareholders, it can deduct these reimbursements and reduce its total earnings, thereby avoiding double taxation. However, the shareholders cannot then turn around and deduct those same expenses on the individual returns. The third point is to maximize deductions. A C corp can further reduce its earnings, the amount taxed at the federal level by taking all possible deductions available to it, including but not limited to travel expenses, equipment rental, utilities, health plan cost, entertainment, consulting services, and the legal expenses, depreciation, advertising cost, charitable contributions, etc. So the other point of discussion is record our net operating loss. C corp are taxed on their income, but if a business loss after deduction exceeds its income, it is not liable for taxes that year. Then carry over net operating losses. If a C corp records net operating losses in 1 year, it can carry over up to 80% of those losses to the following year for further reducing its taxable income. Then the point of accelerating depreciation comes. So when we talk about this point, when a C corp purchases equipment such as computers, printers, or a machine for manufacturing, it has the option of depreciating the cost evenly over several years, deducting more depreciation in the earlier years of the equipment's lifespan and deducting it all at once in the year. So the other point is claim tax credits. Many businesses are eligible for a wide range of the credits, which differ from the deductions in that they are subtracted directly from the earnings. The IRS list dozens of the possible credits, but the most common one are the number one is energy credits for various sustainable energy particles. The second point is that IRS have listed possible credit is research and development credit. The third point in this discussion is investment credits that are to encourage investments in manufacturing and sustainability. The fourth point is work opportunity tax credit. The fifth point that IRS has listed in this possible credit to claim the tax is pension plan startup credit. The second last point of the discussion is disabled access credit, and then comes the employee provided child care credit. Then the last point of how you can avoid double taxation is claim a general business credit. Not non-publicly traded companies that makes less than the $50 million per year can also claim what's now as a general business credit. IRS form 3800, which combines the total value of all the credits a business has taken into a single credit for a specific year. So when we come to the conclusion, those C corp are subject to the double taxation. The C corp business structure offers numerous benefits, especially for the companies on the aggressive growth path. From a tax standpoint, C corp also provides advantages for a smaller business owners, such as mechanism for avoiding the self-employment tax and greater flexibility when it sum to reductions, salaries, and dividend distributions. That said, C corp taxes can be extremely complex, and only an experienced tax professional can explain how all the rules might apply to any given organization. Many C corporation hire accountants and lawyers to hone their tax strategy, of course, but there are other options for the business owners that want to manage their own affairs. So hope this discussion is beneficial for you, so do subscribe my channel for more helpful videos. Thank you.